Imagine waking up to discover the rules that governed 98% of everything you buy, sell, or manufacture just vanished in a single week. That is not hyperbole, that is Tuesday. In the last 9 days, the baseline tariff rate on over $3.2 trillion in annual cross border goods has jumped from under 3% to a weighted average above 24%, the fastest structural increase in modern trade history. At the exact same moment, global announced capital expenditure on artificial intelligence infrastructure crossed $1.1 trillion for the 2026 to 2030 window, more than the entire GDP of India. Two tectonic plates just collided: protectionism on steroids, and the biggest technology investment surge ever recorded. The world didn't just react. Markets froze, then rerouted. Container bookings from Asia to North America dropped 41% in 72 hours. European power futures for 2027 spiked 68%. The Baltic Dry Index, the boring heartbeat of physical trade, fell off a cliff. This is not another tariff skirmish. This is the moment the post-1995 global trading system, the one built on ever lower barriers and just-in-time everything, quietly ended. What replaces it is a bifurcated planet. One lane for trusted technology corridors, another for everything else, with toll booths guarded by policy and code. The deeper question hiding in plain sight: why did the tariff shock and the AI spending explosion detonate within days of each other? Random noise or synchronized design? Here's the nudge that should stop you cold. The largest synchronized tariff increase since Smoot-Hawley in 1930 is happening at the precise instant humanity needs the most coordinated supply of chips, rare earths, and power the world has ever demanded. That timing is either the worst coincidence in economic history or the most deliberate rewiring imaginable. For families, this means the era of $39 televisions and 2-day shipping from the other side of the planet just entered the emergency room. For companies, entire balance sheets built on 2 to 4% tariff assumptions now require emergency surgery. And for nations, the old playbook of export your way to prosperity just got shredded. But before you think this is only about higher prices at the checkout lane, wait until you see who actually engineered the timing and why the AI boom made it inevitable. That's next. The tariffs didn't appear out of nowhere. They were the loaded gun. The AI investment tsunami was the finger that pulled the trigger. Follow the mechanism. Every advanced AI training cluster scheduled for 2026 to 2028 requires roughly 25,000 to 100,000 high-end accelerators. 94% of those are currently fabricated in one single metropolitan area on the island of Taiwan. The refined neon, the EUV lenses, the photoresists, almost all flow through choke points no wider than a few industrial parks. When institutions run the math on strategic vulnerability at that scale, the behavioral response is predictable. Secure the stack at almost any cost. Tariffs become not punishment, they become insurance premiums on civilization-scale risk. Look at the capital flows. In the last quarter alone, announced spending on domestic or allied nation semiconductor fabs hit $410 billion. That is more than the entire U.S. interstate highway system cost in today's dollars. Power grid upgrades to support AI-scale load centers, another $280 billion locked in. Undersea cable projects rerouting around traditional hubs, $72 billion, all of it front-loaded because the training windows for frontier models close fast. The psychology inside the institutions is pure loss aversion on steroids. Nations watched the 2020 to 2022 supply shocks and learned the same lesson behavioral economists have documented for decades. Humans and governments will overpay dramatically to avoid repeating a pain they have already felt once. But here's the part nobody expected. The tariff wall and the AI subsidy avalanche are creating a gravitational pull so strong that global supply chains are now snapping into two distinct orbits faster than any model predicted. One orbit keeps the bleeding-edge compute stack inside a narrow, trusted perimeter. The second orbit, everything else, suddenly faces 25 to 60% friction. The speed of that bifurcation has stunned even the agencies that designed it. Companies that spent 30 years optimizing for 1 to 2% cost advantages are now moving entire continents of production in 18-month sprints. The phrase you will hear in every boardroom from Seoul to Stuttgart: friendshoring at warp speed. And it gets deeper, because the same week the tariff schedules were finalized, something else happened in the energy markets that almost no one connected until now. While cameras focused on tariff headlines, The global energy complex just executed its quietest revolution in 50 years. Watch the data. Announced liquefied natural gas import terminals in Northwest Europe and East Asia jumped 180% in committed capacity, all targeting completion by late 2028. Why 2028? Because that is the exact year the largest AI training clusters come online and begin consuming power equivalent to mid-sized nations. Historical parallel. This mirrors the 1973 to 1979 period when OPEC's price shock forced a permanent rewiring of industrial geography. Only this time, the shock is self-imposed, and the goal is not cheaper energy, it is guaranteed energy for the new commanding heights of the economy, intelligence infrastructure. Other nations are not waiting politely. India just locked in 15-year take-or-pay contracts for 28 million tons of LNG per year. Japan quietly nationalized 2 additional chip material suppliers. Brazil and Indonesia simultaneously restricted raw nickel and bauxite exports, the feedstock for the aluminum that cools the data centers. The behavioral insight is brutal. Once a resource becomes dual-use, civilian plus strategic AI, it stops trading freely. Period. Markets understand this faster than governments admit it. The forward curve for industrial power in allied jurisdictions now trades at a 40 to 70% premium to the rest of the world, a spread that did not exist 18 months ago. That spread is the new geopolitical risk premium baked into every electron. It gets deeper. The same protectionist logic that started with chips is already metastasizing to the periodic table itself. Lithium, cobalt, graphite, gallium, every element on the AI critical list is watching tariff or export control proposals move through committees right now. The pattern from history is unmistakable. When a new general-purpose technology emerges that is both capital-intensive and geopolitically lumpy, the trading system fragments first, then rebuilds around new blocks, steam to coal to British century, oil to internal combustion to American century, compute to AI to the map we are drawing right now, in real time. But the part the media isn't discussing, the part that will hit households and portfolios long before any new fab turns on the lights, is already in motion. Forget the sticker price shock everyone is bracing for. That's the distraction. The real impact lands in 3 invisible waves. Wave 1, wage arbitrage just died. The 22 to 28% labor cost gap that justified shipping a container 12,000 miles is now erased by the new tariff plus energy plus resilience premium. Behavioral economics calls this a reference point shift. Companies don't optimize for absolute lowest cost anymore. They optimize for variance they can survive. That means millions of manufacturing jobs that left in the 1995 to 2015 window now have a realistic path home or to allied nations within this decade. Wave 2. The inflation everyone fears is real, but it will be strangely concentrated. Expect 8 to 18% higher prices on physical goods that cross the new tariff moats: electronics, vehicles, appliances, clothing. Simultaneously, anything that can be digitized and run on the new AI stack will deflate towards zero. The basket your central bank tracks is about to split in 2, and no statistician has a model ready for that schizophrenia. Wave 3, the one no one is pricing. The productivity explosion inside the trusted corridors will be so large, so fast, that the gap between the AI haves and have-nots will dwarf anything the globalization era ever produced. Entire professions, accounting, legal research, software development, radiology, will see 40 to 70% labor hours evaporate while physical production costs rise. The net effect on inequality inside countries could be more extreme than between countries. For families, this means a decade where the television gets more expensive, but the medical diagnosis gets essentially free. Where the car in the driveway costs more, but the insurance drops 60% because the AI drives better than any human. Where your kid's textbook is personalized by a tutor that never sleeps, but the school bus still runs on diesel that just crossed a tariff wall. And here's the pattern interrupt that should keep you up tonight. While the entire world fixates on the tariff drama and the shiny new AI clusters rising in Arizona and Saxony and Taiwan, the real transformation, the one that will decide who leads the next century, is already happening somewhere else entirely. It's happening in the quiet redesign of money itself, in the energy contracts signed last month, and in the undersea cables that just went live this morning. The trade war you think you're watching? That's the cover story. The real rewiring is already complete, and the map just changed forever. I'll see you in the next transmission. Stay awake.